Okay, let's jump right in. When one company invests in another, it's so much more than just a simple line item on a spreadsheet. The way that single investment gets reported can completely change how we see a company's financial health, its size, even its profitability. It's a pretty fascinating corner of the accounting world. And today, we're going to make it all make sense. So let's start with the big question, right? When a company buys a piece of another, how does that actually show up on their books? And more importantly, does buying a small, let's say 20% stake, look anything like buying a controlling 51% stake? Well, the short answer is no, not even close. And that difference is what this is all about. You see, the key to unlocking all of this isn't some random, complicated rule. It really just boils down to one powerful concept: influence. The accounting method you have to use is all determined by just how much influence the investor has over the company they've put money into. To make this super simple, let's think of it as a ladder of influence. This is going to be our roadmap. At the very bottom, with less than 20% ownership, you've got basically no real say, no significant influence. Climb up to the middle, somewhere between 20 and 50%, and now you've got significant influence. And then, at the very top, over 50%, you're not just influential, you have control. And each step up this ladder, it demands a totally different way of looking at the numbers. So, let's start on that first rung. Here, with less than 20%, the investor is pretty much just a passenger. They're along for the ride, sure, but they have no real say in where the car is going. And the accounting? It totally reflects that distance. For these small, passive stakes, the accounting is pretty straightforward. The investment just sits on the books at what it cost, or, what it's worth in the market today. The main thing to remember is this: the two companies' financials stay completely separate. It's a total arm's length relationship. Okay, let's climb to that second rung, because this is where things get way more interesting. This is when an investor owns between 20 and 50%. Now they have significant influence. We're talking maybe a seat on the board, a say in big decisions. This closer relationship requires a whole new accounting approach, the equity method. So here's how the equity method works, and it's a fundamental shift in thinking. The investment starts at its original price, but it doesn't just sit there. It becomes a living, breathing number on the balance sheet. When the company you invest in makes a profit, you add your share of that profit to the investment's value. But when they pay you a dividend, the value goes down. Suddenly, your books are directly reflecting the performance of the company you've invested in. Let's walk through a quick example to really see this in action. Let's say Branch Company buys a 20% stake in Williams Company for 200,000 euros. Simple enough. Initially, that investment is just recorded right there on Branch's balance sheet at cost. Now, watch what happens. In the first year, Williams goes and reports a profit of 200,000 euros. So Branch gets to recognize its 20% share. That's 40,000 euros. And that amount gets added directly to the investment account, bumping up its value right on Branch's books. But then Williams pays out some dividends. Now you might think that's income, right? Nope. Under the equity method, it's treated as a return of your investment. It's like getting some of your original cash back. So that 10,000 euros in dividends actually reduces the value of the investment account. So after 3 years of Williams making money and paying out dividends, you do the math. You add up Branch's share of all the profits and subtract its share of all the dividends. And that investment account, which started at 200,000 euros, has now grown all the way to 310,000 euros. It perfectly reflects Branch's claim on the profits that Williams has kept in the business. All right, it's time to climb to the top of the ladder. When ownership blows past that 50% mark, the game changes completely. The investor isn't just influential anymore. They're in control. They are officially in the driver's seat, and the accounting has to show this new reality. With the acquisition method, that single line item for the investment, it just vanishes. Instead, the parent company literally combines or consolidates the subsidiary's entire balance sheet with its own. All the subsidiaries' cash, their inventory, their debt, all of it gets added line by line to the parent's financials. On paper, they've become one single, much larger company. And this process often creates this very unique, kind of weird asset called goodwill. The easiest way to think of it is as the premium an acquirer pays above the fair market value of the company's assets. It's the price you pay for all the good stuff that isn't already on the balance sheet, things like brand reputation, customer loyalty, or future synergies. And if you can believe it, things get even more detailed here. There are actually 2 ways to calculate this goodwill. under the full goodwill method, you calculate it on 100% of the subsidiary, even if you only bought, say, 80%. Under partial goodwill, it's only on the chunk you bought. Now, why on earth does this matter? Well, because under the full goodwill method, the company instantly gets to report higher total assets, making it look bigger right from day one. And this just brilliantly illustrates the huge impact of consolidation. Look at the parent company before the deal, 49 million in assets. After acquiring the subsidiary and using this method, the new consolidated company suddenly shows over 64 million in assets. The company's balance sheet literally blows up in size almost overnight. So, this brings us to the most important question. Why does any of this matter? Well, it matters because these different accounting methods can paint two wildly different pictures of the exact same company's performance, especially when you start looking at key financial ratios. Let's just compare them side by side. Get this. Even though the net income, the actual bottom line profit, is identical under both methods, the ratios tell a completely different story. Under the equity method, where your reported assets and equity are lower, key metrics like net profit margin, return on equity, and return on assets all look way better. The company just looks more profitable and a lot more efficient. This chart just makes it crystal clear. The acquisition method adds all of the subsidiaries' assets and equity to the parent's books, which massively inflates the bottom number, the denominator, of these ratios. So while the profit is the same, the return on those much larger assets and equity looks a whole lot lower. An analyst could look at this and think the company is getting less efficient, even though the underlying business is exactly the same. So after climbing this whole ladder, what's the big takeaway? It's that accounting isn't just some passive mirror that reflects reality. It's a lens, and that lens actively shapes how we perceive that reality. Think about the journey we just took up the ladder of influence. We went from being a passive passenger with a tiny stake to getting a seat at the table with significant influence, and then finally to grabbing the steering wheel with full control. And we saw how each step up forced us to use a completely different accounting lens to see the very same investment. Which leaves us with a final and pretty profound question. If the choice of an accounting rule can so fundamentally change how we see a company's size, its efficiency, and its profitability, it really forces us to ask, what does financial truth actually mean? And how important is it to always know which lens you're looking through?